Right, how's it going, everyone? Name is Michael EJ. Wanted to take some time to talk about Palantir and how it plays into the way I evaluate companies in general. Now, here's the thing. Everybody's getting Palantir wrong. The Bulls and the Bears. Both are kind of missing the boat in understanding Palantir's valuation, not just today, but going forward. But don't worry, this is where the professor steps in. So let's actually step in and discuss why Palantir's valuation actually makes sense. Now, inspiration here. Of course, it starts with the interview. Starts with the interview back in October and the bad-ish crazy comment that was made. And I get it. You're coming off a great quarter of results. That rule of 40 number is a little inflated. I'll kind of touch on that a little bit later, but regardless, does look amazing. And then that's when you finally have this big short, Michael Burry, against you. So yeah, just reacting on the spot. And Alex Karp is already somewhat of a character. He's already an interesting personality. So catching him on the spot like that, not surprising that was the comment. And then you actually hear Burry explain his position a little bit more. You hear him talk about it a little bit more on the Against the Rules podcast. And I will actually put a link in that interview in the description below, because I don't think a lot of people know he got on that podcast. I don't know how many people know Michael Lewis has a really good podcast, really good storytelling, but got a special interview with Michael Burry. And of course, when you hear different people talk about Palantir, the 2026 projections and all that, heard a little bit on the Motley Fool. I even heard it from some of the bulls, even here on YouTube, that are still kind of missing the boat. So, all right. This is where I'm like, all right, the Bears definitely don't get it. I don't expect them to get it. The Bulls don't get it either. So we gotta do a little bit more explaining. Now, before we dive into all that, let's start off with a company overview. Okay. Now, there are several versions of how Palantir found its footing overall, but what is clear is that Palantir started with several people from PayPal, and including Peter Thiel. Peter Thiel was kind of a driving force behind it. Shortly after starting the company, they brought on Alex Karp, and Alex had a vision of connecting Silicon Valley with national government defense, especially at a time where working with big government was not popular in the Valley. So it led to an initial investment from In-Q-Tel. In-Q-Tel is actually a VC firm associated with the CIA and the rest of the intelligence community, and served as Palantir's door into big government. And overall, this is why they pretty much start off with government as a focus. They have two key areas. Got Gotham, which is like a software or a solution mainly for large government agencies. And you have Foundry. Foundry, it's easier to think of them as just serving large businesses, enterprises, but actually small and even some local state governments, they can also fit in the Foundry lane. But to make things easier, we're just going to separate Gotham for government, Foundry for commercial or enterprises. Now, the company went public in September 30, 2021. I don't know why I got 2025 there. Ignore that 2025 numbers, 2021. Oh, no, 2020. It's 2020. But regardless, company's done amazing. The company's done absolutely amazing over the 5+ years been public relative to the S&P 500. And yes, it's done that well, even while almost every Wall Street pundit has hated on the company. Hated it. Why do they hate it? It's not that. That's not that hard to believe. It's the valuation. Starts and ends mainly with the valuation. Now I have pulled up, as you see on the table, looking at the MAG 7, and I'm also adding Broadcom in there. I think Broadcom should count. And you just look at the valuation differences, especially the forward price to earnings, and then trailing EV to revenue. I'm big on looking at enterprise value. Just looking at those things. It's like, all right, on certain aspects, price to earnings, only Tesla looks more egregious. But at the same time, EV to revenue, Tesla looks a lot more reasonable. And maybe NVIDIA looks high and you can easily justify NVIDIA's revenue. So Palantir still shines highest. Still pretty ridiculous. And I don't even think it's the PE multiple that gets people. It's the revenue. The revenue multiple is what gets people in a tizzy. That over 100 times trailing EV to revenue. That's what gets people tripped up. Especially when you just look on the surface. Does the margins and the other aspects, does it actually justify it? A little shaky. But there's some reasons why it's actually more justified. Yeah, because when you just zoom in and look at the averages and just look at how different Palantir is, even if it comes with higher growth and higher margins, does that mean it deserves that big of a valuation gap? Now, before we start truly diving in, let's revisit how we got here in valuation. Set the stage. So keep in mind, this is something Michael Mabuzin mentioned. Valuation multiples are just a shorthand for a discounted cash flow analysis, a DCF. Discounted cash flow analysis is the intrinsic value of a company. And what's the value of the company? The present value of future cash flows. Or another way of saying, forecast what the future cash flows of the company will be, and then discount that back to today. Based off of some discount rate, it can be mainly your own rate of return, things of that nature. This thought process, as well as pretty much all the way we think about financial analysis or valuation, actually comes back to Graham and Dodd, which means it comes back to a time where we were trying to evaluate companies and understand the stock market during the Great Depression. I just want that. I want everybody to be on the same stage here. We have not evolved that much since then in terms of how we look at companies. And we look at them in a similar fashion. We have similar guardrails. So what are those guardrails? Okay, first of all, you look back at depression, look now. Valuation works really well when you're looking at companies that sell tangible products, things that you could touch. Reinvest in tangible assets, again, things you can touch. And most importantly, this is the most important thing. You're looking at companies that are in I would call the mature, stable stage of the corporate life cycle. There's a lot of things that come with that. Think about companies that are mainly mature. They're large enough. They're mature enough. Easy to understand the industry that it sits in. These are what the tools we've been using. This is what they're built to evaluate. Now, I discussed these variables. These are the top 5 variables just for discount cash flow analysis. I discussed these variables in my Ferrari video, particularly focusing in on number 5, the forecast period. That's something people get wrong a lot. Ferrari is a special case where I believe even though they're probably closer, on one end they're closer to mature, stable, they deserve a longer forecast period than you would think. But this one, not necessarily a special case, actually makes sense when you get the stage of the corporate life cycle correct. Now, again, shout out to Aswat the Motorin for his book on discussing the corporate life cycle and a lot of videos, a lot of materials. And I even utilize a lot of his stuff in the classes I teach today. So this is the life cycle, 6 stages. This is what a lot of the toolkit, the way we analyze companies, it's built for mature, stable companies. This is where I would call it the Goldilocks of evaluating companies and Goldilocks of finding winning stocks, typically in the stock market, somewhere in that mature growth, maybe transition to mature, stable, maybe not. They're holding off. That's kind of a good testing ground. And you can still use a lot of the typical tools that we've been taught to this point. You can still use it here. And then you got where Palantir sits. Palantir is squarely in high growth, maybe approaching mature growth stage in a few years, but today they are high growth. So what does that mean? Well, it means several things. Probably one of the things, and you'll see in the chart here, there's a lot of overlap on this table between different aspects. But the big thing to keep in mind is that high growth narrative play a little bit of more of a role. Okay, maybe some of the numbers and expectations are a little bit higher than what we're used to. So if we were to take that and keep that in mind, let's look at technology companies in particular, especially technology companies with a software focus. Because you start at the top and look at the representative companies and look at their revenue multiples, since that's the cleanest way to look at these companies. And by the way, I'm evaluating Palantir as of January 5th, 2026. So by the time I'm recording this, I believe their multiples are actually a little bit higher than this, maybe closer to 108, 109, but still bear with me, looking at 101. So you can see, if you just look at on the right side, you see how the multiple has increased over time. You can pretty much just map it to the stage. Stage maps pretty well to revenue growth in most cases, especially when you're not considering super cyclical companies or commodity based companies. So you got you got nice laddering that happens, moving from different stages, as well as you see the revenue growth playing in. But at the same time, there is something that is very interesting in that if you come down to the bottom, you look at Crowdstrike, you look at Palantir, and that is where the valuation conversation actually starts. It shouldn't start looking at Palantir versus the Mag 7. Okay, that's a different conversation. We're looking at two different stages. The conversation needs to start with Crowdstrike. Because Crowdstrike is actually in a similar stage and maybe a year or two ahead of Palantir in a lot of situations. With that, yeah, you're looking at essentially Palantir, at least on the revenue line, double the growth of what Crowdstrike is. Now, here's the thing. Based off of that and based off of how things were climbing just in general, I can see cleanly a 20 times difference, 40 times difference, maybe even a 60 times difference, which means if Crowdstrike is trading around 24 times, then yeah, if Palantir was trading around, I call it 80 times trailing EV to revenue, I think it actually makes plenty of sense just on that alone. But 77 times, that is a little high. It's a little high just, on the surface. So, which just means we just have to dive a little bit deeper to understand this difference. Yeah, because that is ridiculous for companies that are in, well, I will argue, are in the same stage, and at least on the surface, don't seem that much different outside of the growth itself. So let's do a direct comparison. Let's just jump straight into it. In this aspect, you can see that there's some differences here, especially in the recent revenue growth. But at the same time, this is what the bulls of the stock are actually paying attention to. And another way of saying this is that they can see Palantir has the potential to be, at least, on paper, when they start to hit fully mature stage, the best software company in the world. I can say that right now. They're not that today. I'm just saying they're not that today, but you can see the potential. You can see the potential. You can see that their competition is actually pretty limited. And I'm saying that at best. You ask the right person, they will say they have no competition. At least Crowdstrike, you clearly understand all the competition they have. From Palo Alto Networks, Zscaler, Datadog, Fortinet. There's a lot. Wiz is a new one. Crowdstrike got a lot of competition. And this customization component, I'll come back to a little bit later. But in general, who has the highest potential in terms of free cash flow margin once the company's more mature? It's Palantir. Now, before discussing a little bit more of those DCF variables that I touched on a little bit earlier, using those to back into what I believe are the market expectations for each company. For doing that, let me explain a little bit more about my investment process and figuring out what's actually priced into the stock, starting with my discount rate philosophy. So you see a couple of things popping up. When I think of a discount rate, I'm not just thinking in terms of using the weighted average cost of capital, which again, this is what we typically are taught to use. So not just thinking in terms of that, but actually break things out a little bit more. Okay. There are normal times where you should have some level of uncertainty, and this helps change that, or either increase uncertainty or decrease uncertainty. And then we got the stress times, the stress reasons, which might align a little bit more with how we typically think of a discount rate. But yeah, again, this is covering a lot more things and thinking about it in a different way versus just using a weighted average cost of capital, and especially using CAPM and beta to find the cost of equity. Now, these are areas where I do believe I have a little bit of a differentiated edge. For me, the biggest edge that I can see that the typical market participant cannot see is an increase in the lifetime value of a customer, and how that actually plays a role in bringing down uncertainty. So this is an area where it normally comes out for me, and these are the different ways I typically see it coming out. Let's also touch on intangible assets. Now, going back again, Dot and Graham, this wasn't really a thing, and accounting principles do not help here. We have research and development and sales and marketing. These are two expenses that are actually longer term investments. Both of them are longer term investments. They are longer term investments just like CapEx. So I treat them just like CapEx. I typically adjust most of R&D so it can fit into the CapEx line, and half of sales and marketing. Thinking sales, okay, that's within the period, whereas marketing's for building a brand is more of a long-term focus. So that's what I typically do. However, for high growth stage companies, I'm going to make them both 100%. So I'm adding back all of R&D and adding back all of sales and marketing. I know some people might disagree with this view, but I don't think it's that hard to argue that these are longer term investments in both, even in sales. In this case, looking at how B2B sales, enterprise sales tend to happen, it is building a relationship over a longer period of time. Now, again, this is only mainly for high growth companies. When you get to that stage and under, typically we go 80 and 50. But again, this is how I'm looking at things from this perspective. I also adjust things in a way where the free cash flow does not change. So you might come across research, and I'm going to link a lot of this research that helps justify my views below when it comes to intangible assets, because that's where I actually got it from, different academic papers. And you can capitalize the R&D expense, and you can capitalize sales and marketing, which means, amortize it over a certain period. Yeah, that's adding too much complexity. That's where it starts to, that's why people normally don't like it. When you start seeing that difference in free cash flow number between what's actually there on the cash flow statement versus what you got with your calculations, and it can throw things off and then get really complicated really quickly. So I don't do all that. I just take the expenses and add them back. What it typically means is higher operating margins and higher operating profit, higher cash from operations, but at the same time, higher CapEx and a higher reinvestment rate. So look at Palantir and Crowdstrike pre-adjustment. And most importantly, look at that reinvestment rate percentage. It is really low, especially versus where it should be. It should be above 50%. Honestly, it should be more like in the 70 to 80% range. But again, when you are a software intangible based company, CapEx is not really a thing. That's not what you're actually reinvesting in. It's the R&D and the sales and marketing. That's where your reinvestments actually come into play. So when you make that adjustment, now the numbers are starting to make a little bit more sense. Yes, those margins are a lot higher. I think that's actually closer to where the margins should be, even at the operating level. I mean, keep in mind, software is a 70%, a lot of times 80% plus gross margin business. So that automatically means the operating margins should be higher. Now, when you make this adjustment and you get the reinvestment rate, now the reinvestment rate starts to make a lot more sense, especially for Crowdstrike. And as you can see, free cash flow numbers do not change. Now let's get to justifying these multiples. A shout out to Michael Mobelson. My favorite book by him, Expectations Investing, kind of put this mindset in my mind in terms of understand what's being priced to the stock first before you start trying to make adjustments and put your own take into it. So as a reminder here, uh, Crowdstrike trades at about 24 times revenue, and how I just adjusted the operating profits, 40 times adjusted operating profit. Um, so in the spreadsheet that I have within the description, again, shout out to Oswald Automotive for that, you see that you can change the yellow cells and you're going to get to different numbers about how to back into whatever what whatever the multiple is. And keep in mind what I talked about before, where high growth should normally fit in. This is what I get for CrowdStrike, the backing to them. And I feel actually pretty good about that. Like, this is a fairly valued company, but where they at and what is expected of them. So these are the assumptions for, again, the top 5 variables, DCF variables. And then these are the assumptions for Palantir. Now, probably the big thing when you just scanning right quick that comes to mind is you see that expected growth rate. You see expected growth rate difference moving from about 21% to 30%. Like that's 9% difference, especially at that high of a level. That is probably the biggest thing that sticks out. And with that sticking out, combined with some other stuff, there's some, if you pay attention, there's some other stuff here. That's what creates the difference in the multiple. So to zoom in a little bit more on that difference, we got a longer forecasting period. A lot of that comes from, you can clearly see the competition for CrowdStrike where there's limited to no competition for Palantir. So there's a lot of that aspect there. You got a company that's also growing faster. Honestly, it's kind of re-accelerated growth if you look at Q3 numbers. Because of the customization piece and even stronger reliance on existing customers, especially their top customers. I'll get to that a little bit later. Got a lower reinvestment rate. Not by much, but a little bit. Okay. I even think because of that aspect in having the government, national government agencies, especially here in the US, as your key customers, you're a safer company than usual just based off of your customers alone. So giving them a little bit lower of a discount rate and a little bit higher of operating margins. Because again, Palantir, you can easily make the case at maturity, they will have the best margins of any software company. So again, you have to buy this story. Remember, narratives mainly drives the bus for high growth companies. You got to buy this story just for the valuation. I'm just able to buy it a lot more than your average investor, even your average growth investor. But yeah, that growth rate is the main driver. And it really points to the exponential difference a growth rate can be. And when you're looking at estimating the expected growth rate, because the expected growth rate is actually supposed to be what's the expected growth rate in free cash flow. That's what it's supposed to be. I have found that that's not always the cleanest way, and it can be a little lumpy, especially for more cyclical businesses. So the more mature the company is, you can look at past growth and operating profit, and that's typically a pretty strong proxy. It's typically what I normally go with. But as you move from super mature to high growth, now you need to pay a little bit more attention to what is the revenue growth been? Because the revenue growth is actually better when you're thinking further out. But yeah, the expected growth rate is the main thing. There's some other changes here too, but this is what drives the difference between CrowdStrike and Palantir's valuation. And from this exercise, and by the way, before I even dive in, yeah, that's the actual difference. The actual difference, and again, it's the revenue. 77 times difference is driven by just a few changes. Again, if you want to toggle with this, click on the link for the spreadsheet, what I use for that analysis, download it, put it in Microsoft Excel, and you can start toggling with some things. Yeah, I've already touched on. These are the main areas where the difference sticks out the most. Now, I have found through this, and this is a lot of what people get wrong, And this is where mispricings tend to happen. Different biases that investors tend to have. When it comes to Palantir, it's the ultimate form of simplicity bias. Not just on what the company does, because people still don't understand what the company does, even people who are invested, but even how it's being valued. Anchoring plays a huge role here. Again, we're used to seeing valuations in certain ranges and thinking about companies, again, from a mature state. And saliency bias. So we're used to focusing on certain numbers or certain things that pop out to us. And this is a little bit different. Again, Palantir is a little bit different. Software companies already have this aspect alone before we were talking about Palantir. So that's why there's so many, particularly value investors, they don't touch software companies. And when they touch them, they tend to be too late. I mean, I put Adobe in there. Adobe's a perfect example right now. People they can't help themselves but invest in Adobe, because if you look on paper, they should be priced much higher. Kind of missing the idea that when it comes to software and tech investments and where growth investors play, the story matters, the narrative matters a little bit more. All these elements are why people get Palantir wrong on their valuation. Just straight up, all the time. Get it wrong all the time. Now, with that said, does Palantir deserve a spot in my portfolio? Now, I recognize that I maybe didn't do the best job of explaining how I think about adding names to my portfolio or just my general investment philosophy. I kind of touched on a little bit, explaining how I think about discount rates, but these are the key principles of the intrinsic growth portfolio. There's an element of me caring about not just what the valuation is today, but what the valuation could be tomorrow, based off various scenarios. The key thing I look at, a lot of people focus on free cash flow or even earnings. Push earnings to the side. That's a horrible metric. I mean, so many investors focus on that. That's already a sign of me not taking you so serious if you focus on accounting earnings. Get to the cash flow, even free cash flow. I recognize, again, when you're looking at companies at a mature state, it makes more sense. But in reality, for the companies I like to invest in, which is more typically in the mature growth aspect, I want companies that are growing from a fundamental level. Meaning you takes whatever return on investment metric you want to take. It could be return on equity, return on assets, return on invested capital. I use return on capital employed. You can look at all these metrics, multiply it by the reinvestment rate, and you get the fundamental growth in the company. That's what I care about. That's the big driver. I want companies that are fundamentally growing faster. And sometimes that means the ROI is catching up. That doesn't always mean that it's the highest ROI today, because normally high ROI today means the reinvestment rate is typically lower. You want to find that balancing act. It leads to what I call an IRR-based methodology. So instead of judging on if a company's undervalued today, I am way more likely to hold a company that's fairly valued if I see that the valuation tomorrow exceeds a certain benchmark. And yeah, this is also where I incorporate some scenarios, some expected value, some EV thinking for those that are in the sports betting. And I typically hold companies, looking to hold them for really 18 to 36 months. So I'm judging in that frame is the IRR that I calculate for that time frame. Will that work out? And yes, not only am I willing to buy fairly valued, I might even be willing to buy an overvalued company if the growth is there and the IRR can be justified. Now, my view on Palantir's valuation. Now, again, I'm just reminding you all, trading at 101 times EV revenue and 159 times EV to adjusted operating profit. Those are some high numbers. Even though I just made all this thing about, hey, it's more justified than you think, still kind of high. This is, again, what was used to justify the numbers. And again, if you actually go inside the spreadsheet, you'll see multiple Palantir tabs, because I want to approach it in different ways. You'll see later. You can take this valuation a lot of different routes when it comes to Palantir. So this is the route I chose to take, and this is what I saw. These are adjustments I made. So the big thing here is I mentioned Crowdstrike. I see their multiple as being fairly justified today. A lot of the reason why I see it as fairly justified today is that if you look at revenue growth over time and you match it to the expected growth rate that I put into the sale, there was a little bit of a gap. Over time, you look at revenue growth, putting more of a focus on revenue growth, look at profit growth a little bit, but you can make a case that recent past growing at a high 20% clip, brought down to 21%. There's a little bit of a gap. Feel more than comfortable doing that. I want to do the same thing for Palantir. Because if you look at the difference between 30% and 27, or in this case, 27.5%, is when you move from 30%, because 30% is almost saying like, hey, they're going to grow at, they've been growing near or a little bit above 30% to this point. And that's too close of a gap. So I wanted to widen it a little bit. So that's what led to the 27.5%. Not super, not a super calculation or anything like that. Just there's a gap that I'm comfortable with in terms of like, this is how fast they grew in the past. They are likely to grow at a slower rate into the future. And I even made up for it. I gave them an even longer forecasting period because I believe, again, there's a lot of benefits of having truly no competition in what you offer. Nobody else is like you. Okay. So I gave them that. All right. I also gave them just a tinge of a higher operating margin, adjusted operating margin at 62.5%. And if you look over the past, it's been about 63%. This is also another reason why I like adjusting for R&D and SMM, because it shows you what the operating margin, not only what it could be, but what it would likely be if you were to strip out a lot of this stuff. If R&D got to a normalized state and S&M got to a normalized state. So I'm giving them a lot of love, but at the same time, it still leads to Palantir being overvalued. Now, you might take that as the headline, Palantir is overvalued. In reality, I have it as only slightly overvalued. Why I say slightly overvalued? Because to me, Palantir should be trading around 90 times EV to trailing revenue. Around 90, not 100, 90. That's a small difference. It's not that big of a difference. So I don't think it's too crazy. They're a little hot, but it's not too bad. Especially not as bad as what people think. Now, I also wanted to show sensitivity analysis here because, again, the main two things I changed is the expected growth rate and the forecast period. That's where it really comes out the most. So I'm giving you an extra year, but at the same time, I'm decreasing expected growth rate. And as you can see, if you move from left to right, it's really the expected growth rate that's the driver. I mean, yeah, the forecast period is a little bit of amplifier, especially if you start moving out to year 16, 17, 18. You start to see that amplification effect, but moving left to right is just stronger to see. Now, the scenarios. Since I am looking to invest in this company over the next 2 to 3 years, over that time period, I forecast out about that far. And especially for this case, it'll be fiscal year 2028, since 2025 is almost up. So key critical factors I'm paying attention to in forecasting. Well, we all know where the conversation really begins when we talk about Palantir's future. It's the commercial segment. The commercial segment is where it all begins, and in a lot of cases where it all ends. That's the big debate. How much opportunity is in the commercial segment? I did do some rough, analysis here, and I used a lot, and I mean a lot, perplexity here. I'm even going to also link, I'm going to share all the work I use with perplexity. It's a great tool, awesome tool that I use for this analysis. And in there, talking about how big is this opportunity for Palantir. Has to be a large enough company and have enough data complexity for this to work, for this to be a selling point. And also, you have to keep in mind too how Palantir sells, how they sell themselves, especially to enterprises and larger businesses in general. It's these boot camps, these AIP boot camps. What essentially happens is, hey, essentially like a 1 day or a few day demo with your company. They take a little bit of what you can, sample and work with. They work with developers on site, and they show how their capabilities can solve problems immediately, like in hours. I don't even think in hours. I think in minutes in some cases. How fast they can gain insight in a way that they would not be able to gain insight using a traditional software product. That's normally how they get their foot in the door. They start there, and then they're like, oh, the more data you show us, the more problems we find, the more insight we can share. And this is where you normally get like a huge bump in sales per customer, per client. And that bump can be the initial contract signed for maybe, I don't know, $1 million, 5 million, 10 million, and then easily 5 to 10x 6 months down the road. Like going from a $5 million contract to $50 million contract in less than a year. Like they just decided to upweight it. Like that's how things are normally sold with Palantir. So you got to understand the go-to market strategy there. The size of the commercial opportunity matters because this is where that sales and marketing spend I was talking about, this is where it's actually going towards. Before this year, I have never seen Palantir advertise. Now, I see them on YouTube commercials because I watch a lot of YouTube. I'm like, why am I getting Palantir advertising? Well, who are they trying to talk to? It initially didn't make any sense, but when you think about it and you look at how spend is increasing, how there's an expectation for it to exponentially increase, it makes sense. Because the R&D, once you got the door in with the government, you got them. And that's kind of word of mouth type of thing. And you could easily make a case that in terms of the large government entities, large agencies, they're already close to tapping out. They're not that far away. I don't think there's any disagreement there, but and also I don't think there's much disagreement in terms of like, hey, at the local and state government level, they have plenty of opportunity, and they're gonna get that. They're gonna make that happen. So I don't think there's any argument there. So the commercial side, if there's plenty of opportunity, they're gonna have a high ROI on this advertising spend, this sales and marketing spend. If it's a lower opportunity, that ROI is gonna go down. So it's just as simple as that. Next up, a big driver is the top 20 customers. Now, top 20 customers for Palantir, I mean, they already at an order of magnitude have like 10x the average contract size of a typical Palantir customer. And you already know these are mainly large US agencies. There might be a little bit of a healthcare or, a Boeing-like figure. I'm not saying Boeing's customer. Nobody actually know who the top 20 customers are. But you can take a gander on some of them, who they are. And again, most of them are US-based, large government agencies like Department of Defense, maybe the CIA, things of that nature. It's already there. So they have been a strong driver of the overall revenue. Now, if they continue to be a strong driver of the overall revenue, I can see that being a little of a problem because they have to continue to find issues. Like they just had an impressive jump in net retention ratio just with these top customers alone. You got to expect that to fade. They're going to eventually stop finding issues or stop finding things. They have to. It's just part of it. But if they keep it just high enough and then let the rest of the customers catch up, because these large jumps that could happen, then they won't be so reliant on top 20 customers. But they're going to be still a little bit reliant on them in the near term. And then lastly, come on, man. It's Alex, the CEO himself. This is like almost like an Elon Musk type of factor that you just have to keep in mind. He can go off the rails. Now, here's the thing. I don't think things are going to go off the rails or he's going to say something that's going to actually hurt the stock unless the company itself is underperforming their own internal expectations. When things get rocky internally, that's when I expect something to go wrong. All the crazy things he say and all the it won't matter as long as the company's performing. But once it stops performing, now we got a problem. So looking at scenario analysis, this is how it all will come together. And I got the probability there, or I think the commercial penetration rate is today. All right. And how it really shakes out in terms of revenue growth, with the revenue growth being focused on total customers, just in general, how they grow. And that's, again, driven a lot by the commercial opportunity and the average revenue per customer. The average revenue per customer actually has decreased over time. It's almost like it's been a very persistent thing that's happened as they add more customers. This is the first year where you can make a case that that's going to finally hit a standstill. They might finally start turning that around and start increasing. And that is, again, if they can continue to find things wrong with the average top 20 customer and continue to grow that, that will be the main driver of turning that from a negative, persistent negative, to a positive. Now, these are the projections I have both at the revenue level and how I break out revenue, and then how it flows through into the profits. If you actually do download the spreadsheet, how the numbers got there, I actually use an add-in called Excel Price Feed. I'll also link that in the description below. Very helpful. It's been very helpful. I've been using that for years. Gotta make some updates every once in a while, but overall, it's been a great experience. And again, nobody really talks about that because nobody really does the modeling part. But in modeling things out, this is for the base model. This is my base projections, how things will play out. Now, the biggest thing here is this is where I think my variant view or my views differ most from consensus or how people look at the company. I think customer growth is going to continue to be high. Again, the government side's kind of already guaranteed. I think average revenue per customer is going to stagnate, not continue to decrease. And a lot of that's driven as much by the growth in the commercial opportunity, as well as by the top 20 customers continuing to spend more, having a higher net retention ratio. So when you connect that commercial aspect to the sales and marketing spend, since we're going to look at things from a gap level, we're going to look at a gap level, how it flows into operating profits. Look at it from that perspective, they continue to have, or a pretty good opportunity here. But maybe by the time we get towards the end of this projection, 2028, that starts to change. It starts to not be as great, at least ROI on it. It starts to come down. It might still be above a certain hurdle rate that they have internally, but starts to come down. Now, just discussing how I typically make decisions for the portfolio, I'm combining three CAGRs. I got the valuation difference today. I already showed what the actual valuation difference is. So about a 10% difference. So I stretched that 10% over a 2 to 3 year period. So in this case, it'll be negative 3%. What the valuation difference is tomorrow. So value the company about 2 to 3 years out into the future. And then expected shareholder yield. So that's combining what the expected dividend yield is for this company, 0, and the expected shareholder yield or changes in shares outstanding. They've been increasing shares outstanding. So from a shareholder perspective, that's dilutive. So that's a negative. I add these three numbers up and I get what I'll call my IRR, my, internal rate of return for the company. If it's above the sector benchmark, it's eligible for the portfolio, or more specifically, eligible to be overweighted in the portfolio. So, base case, my view on tomorrow's valuation. Okay, pay close attention here. We got the sales multiple. Remember, I think it should be 90 times. 3 years from now, I'm saying it should be 56 times. Like when you just naturally decay things, that's what you get. Also notice I'm now using a free cash flow multiple because they already generate enough cash to use a free cash flow multiple, but it looks egregious now. It's still going to kind of be egregious in the future. I'm just letting you know, but that's fine. Essentially, when you put it all together, I'm assuming that valuation tomorrow difference, when you do it as a CAGR over 2 to 3 years, about 18%. So you add this all up. You got the valuation difference today, got the valuation difference tomorrow, got expected shareholder yield. Keep in mind, Palantir's been increasing shares outstanding by recently about at a 5% clip. So I'm just taking half of that. You get to an IRR about 12%. Now, if you were comparing this to the market in general, this is not that bad. I would say the market in general, you can put an IRR at 8 to 10% and this will be justified. That's not what I do. Instead, I look at it versus what would this IRR calculation be for the technology sector? That's where we get a difference. Because for the technology sector, I don't have the the hurdle at 10%, 8 to 10%. I have it at 13. It's a higher hurdle. It should be a higher hurdle. Look at the options. Look at the opportunity cost. See how Nvidia is growing? You see how all these other companies are growing? Yeah, it's a tougher hurdle to beat. And it should be a tougher hurdle to beat. Or else, if it wasn't for that, I'll just be investing in technology companies. And that's not what I'm trying to do with my portfolio. It's part of the reason why I got, been scared out of the portfolio in the past. Too much technology exposure. I talk a little bit more about that in my podcast, Championship Investing. So you'll see the card pop up right here and talking about it. But when you make that comparison, you look at Palantir versus the technology sector. Now I'm like, oh, this is actually kind of negative. It's just right under the 13% threshold. Now, focus a little bit more on the bear case. And again, bear case wise, would it be surprising if Alex goes off the rails, especially when things aren't going well? Yeah, wouldn't be surprising at all. So this could have a really bad outcome, like terrible. Like I know it shows CAGR here, negative, close to negative 22%. In reality, that is saying this can lose like 80, 90% in a real bad case, in a real bear case. And I'm thinking about this. You can make a case that this could happen simply in a market drawdown, but I don't know how much that will affect the fundamentals. I'm talking about something fundamentally going wrong with the company where the rest of the market is just being stagnant or doing this thing. Be really bad. Things low chance, but it can be really bad. Just like low chance, things can be pretty amazing. They can be pretty amazing. If that R&D spin continues to lead to innovations with both of Palantir's products, and it leads to continue to find things at a very high clip with those top customers, and even higher upcharging, and even that penetration rate is relatively low for the commercial opportunity. They still got plenty of runway, more than even I think. It can be pretty amazing. This is the ultimate boom or bust. Ultimate boom or bust. It can be pretty impressive. So based on all that, still get to a point where it's just like, even though I keep that in mind, I still see, the IRR being above the hurdle. I still don't see it. But at the same time, Palantir is still in my portfolio. So you might be wondering, why? How's that the case? We went through all this exercise for you to tell me it shouldn't be in there, but you got it in there. What gives? Well, it's a very important underweight position. Keep in mind, I don't think in terms of this company should be in the portfolio or it shouldn't be in the portfolio. I think in terms of what's overweight or underweight relative to the S&P 500, because that's the benchmark I'm trying to beat. I recognize for myself, trying to aim for an absolute return is not really what drives me. What drives me is beating the benchmark or not. So even if the market was down 20%, if I was only down 18, I'll be more than happy. Sure, I lost money, but in my view, I'm doing my job. Now, why is it an important underweight position? Well, here's the thing. In the S&P 500 now, Palantir is a top 20 position out of 500 plus companies. I think it's, to be exact, about 16. So that's still, in weight wise, is less than 1% weight of the S&P 500. About 65 bips or, 0.65% from this traditional view. But to take it up a notch in terms of complexity, and again, I got another podcast on that, so you see the card popping up. To take things up a notch, you look at it from a risk perspective or a volatility perspective. There are times where Palantir moves the market in a way like it's a top 10 position. When you start playing in that space, because of how volatile the stock is, I have to pay attention. I have to pay attention to the top 10. Really the top 15, so it's already on the cusp. But especially when things start to get rocky, or even if there's upside volatility, that can happen too. It's moving like it's a top 10 position. Because so, I have to hold it. Even if I hold it at a very small weight, which is what I do. It's about 40 bips or 0.4% of my portfolio. Really small, really tiny. To some people, it's not even worth it. Not even worth the hassle. But for me, it does still serve a role. What I would call a high beta role. I explained the intrinsic growth portfolio. In reality, what that comes out to is I'm a quality growth investor. I care about high quality companies that are growing faster than peers. That's what I care about. So if you looked at the Ferrari video, it's and still one of my top holdings. Why is it a top holding? Very, very high quality company that I actually think is growing slightly below peers, at least what I would consider peers, or just right with peers, but very high quality. So yeah, I'm willing to roll with that. But what that means is I would typically overlook stocks that have a super high volatility, super high beta, because the beta and the volatility serves at times a little bit like a proxy for quality. There's a lot of portfolio research that also points to, leaning more towards safer stocks or low beta. I might just throw that in the description too. Just a lot of research pointing to that. So that's how I normally run my portfolio. But I've also recognized over time that you need a little bit of the high beta stuff. And Palantir definitely serves that, especially when it's actually acting like that, when it's playing too big of a role. And lastly, in keeping Palantir, I'm allowing for some potential forecasting error, particularly on the expected growth rate. I already mentioned before, I wanted at least a widened up gap between the recent revenue growth and what's being projected going forward that was similar to Crowdstrike, because Crowdstrike, I truly believe, is fairly valued today at 24 times trailing sales. But just a little bit of a change, a little touch of a change on my base case, unexpected growth, can make the world of a difference. If I just moved it from 27.5 and just move it up to 10 bips, 10 bips, and then we're right in line. Move it up 20 bips, we're clearing it. Make it 28%, it's way ahead. So, similar to a DCF, there's a lot of sensitivity that comes with using this back into valuation multiple. Because again, DCLs, when you make small changes, it can lead to big results. It's the same thing here. So in reality, even though I have the expected value or the IRR being just under the sector at 13%, in reality, I see it as is right in line or it's too close to call. Now, this doesn't mean I will overweight it or even make it a market weight position, because I still would prefer to hold other things. But it still means that, especially when it can move like a top 10 position, I'm putting it inside the portfolio. Now, which stock am I going to do next? Now, I've already talked about this decision back in the Ferrari video. Anything about, and it's data center related between Vertiv Holdings and Celestica. That decision is still kind of pending, although Celestica's weight, I've kind of moved around a lot over the past few months. But it did get me thinking. When it comes to the data center aspect and how things can play out, I really like Broadcom. Broadcom has come up to the forefront as a name that I really like. Google's also there too. And what's interesting about Google is that value investors starting to see it, which on one end is great, on the other end might be a little bit concerning, but there might actually be something there. But if we're going down the data center route and the AI route, there's no company like TSMC. I have a personal belief. TSMC is the most important company in the world today. Hands down, there's no second. But if there was a second, it would be TSMC's main supplier, ASML. You saw that YouTube video that recently came out that showed the inner workings of creating these large things that ASML pushes out. It's pretty legit. It's pretty legit, right? The only company in the world that can produce this, the true definition of a monopoly. Hard to not buy into it. So it's like, all right, we got all these moving parts in AI and data centers. This is a big theme in the portfolio and in the market in general, instead of trying to look at all these companies individually, what if I look at them all in aggregate? And where it all starts is NVIDIA. So that's what we're going to dive into next time, and how I'm thinking about sizing positions around NVIDIA. This is Michael EJ signing off. Till next time, stay tuned.